So, you're thinking about investing in Georgia's absolutely booming property market, huh? Smart move. But there is one thing you have got to understand, and that's property tax. Now, it works a little differently here than you might expect, but trust me, once you know the secret, it's actually pretty simple. So let's decode it together.
Right, so you're here. Maybe you've already snagged that perfect apartment in Tbilisi, or maybe a gorgeous house overlooking the sea in Batumi. Or hey, maybe you're just dipping your toes in, exploring the idea. Either way, you are in exactly the right place, because getting a handle on the local tax system is the key to making a really smart investment. And here's the good news. The Georgian property tax system, it isn't random. It follows a very specific logic. And once you grasp just a few key ideas, the whole puzzle just snaps together. So over the next few minutes, we're going to walk through it step by step and turn any confusion you might have into total clarity. Okay, first things first, let's get on the same page about what we're even talking about. When the government of Georgia says property, what do they actually consider taxable? Well, the answer might just be a little broader than you think. See, it is not just about your land and your building. In Georgia, the property tax for individuals also covers your car. And yeah, if you're lucky enough to have one, your yacht or your helicopter. This is a really crucial point to remember. It's a tax on a whole range of your assets, not just your house. All right, now let's get to the single most important concept you need to wrap your head around. I want you to forget everything you think you know about property tax from other countries. Because in Georgia, at least for buildings, the entire system hinges on one central idea. That's it. That's the secret. The tax rate you pay isn't just based on how much your property is worth, it is directly tied to how much your entire household earns in a year. This is the key that unlocks the whole system. But, that brings up a really important question. What exactly counts as a household? And this is where it gets really interesting. Georgia's definition of a household is, well, it's broad. It's not just you and your spouse. It includes the combined worldwide income of your minor children and even relatives like your parents or your grandparents if they live with you. This is such a critical detail for figuring out what your potential tax might be. So, now that we know the what and the who, let's get down to the how much. This is where we put that whole household income concept into practice and actually see how it translates into a tax rate. This chart just lays it out perfectly. It's a three-tiered system. Look, if your total household income is less than 40,000 Georgian lari, guess what? You're completely exempt from tax on your buildings. 0. If you're between 40,000 and 100,000 lari, you're in a super low tax bracket. And if your household brings in over 100,000 lari, the rate is between 0.8% and 1% of the property's market value. So the main takeaway is simple. Higher income means a higher tax rate. But hold on, there is a huge exception to this income rule. Land. Land is treated completely differently. So while the tax on your apartment building depends on your income, the tax on the actual land it sits on, that's a fixed amount set by the local government. Your income is totally irrelevant for that part, and you have to pay it no matter what. And hey, for all you entrepreneurs out there, listen up. There's a special rule for you. If you have what's called small business status, only a quarter of your business income counts toward that 40,000 lari threshold. So, for example, if you earned 100,000 lari, only 25,000 would count for this calculation, which means you'd be exempt from property tax on your buildings. That is a fantastic perk. Okay, so we've nailed the main property tax, but what about other taxes related to real estate? Like when you sell your place or rent it out. Let's take a look. And I've got a feeling you're going to like this part. Seriously, this is where Georgia's reputation for being tax-friendly really, really shines. Beyond that annual property tax, the rules for actually making money from your real estate are incredibly attractive for investors. Let's start with this number, 2. 2 years. If you own a residential property for more than 2 years and then you sell it, how much capital gains tax do you pay? The answer is 0. Nothing. A complete tax exemption. That is a huge incentive for anyone looking at long-term investment. And what if you're renting your property out? Doesn't matter if it's a long-term lease or you're doing short-term rentals on Airbnb. The tax on your gross rental income is just a flat 5%. That's it. It's simple, it's low, and it's incredibly easy to manage. All right, we've covered the rules, we've covered the rates. Now for the final super practical piece of the puzzle, the deadlines. I mean, knowing the rules is great, but missing a deadline can get expensive. So let's lock these dates into our brains. The timeline is really straightforward. Your tax is always based on the property you owned in the previous calendar year. You've got until November 1st to file your declaration, and then until November 15th to actually pay the tax. So, for property you owned in 2024, you'd file and pay in November of 2025. Simple as that. And just a quick but really important word of caution. This isn't just friendly advice, right? These are legal obligations. If you fail to declare your taxable assets, it could lead to some pretty hefty financial penalties. So it really, really pays to get this right. So there you have it. From understanding that it's all about your household income to knowing the big difference between land and building tax. And of course, marking those key November deadlines on your calendar. The system is officially decoded. So the only question left is, now that you have this clarity, how does it shape your next move?